Welcome students, this is Damien Angelo Labro here. In this video, we will be looking at cost of sales. Now, let's say a business buys 40 mobiles at $200 each and they sold 30 mobiles at $300 each. Right? Now to calculate the profit, guys, what should you do? You take your income, from that you reduce your expense. Right? So, the income from one mobile phone is $300. The expense of one mobile phone was $200. So the profit from one unit should be how much? $100. So you have sold 30 units. So altogether you should create a total profit of how much? Yes, 100 into 30 will be $3,000. Right? Now let's look at this. So the income I have taken from 30 units, but when you look at the expense, I have not taken the expense of the entire 40 mobiles. I have only taken the expense of the 30 mobiles. Guys, when you calculate your profit, you calculate it for a certain period, right? And the inventory will become an expense only when it is sold, right? Now, if you can properly understand it, if you have looked at my accounting equation video, right? So you can look at that video where we first discuss in detail how the inventory has been transferred to the cost of sales, right? Now, when you calculate the gross profit, you need to consider the cost of the goods that you sold, because when the goods are sold only it will become a cost. Unless if the goods are not sold, right? Now the remaining 10 units of mobiles, they are your inventory, they are a part of your stock. Now that stock is an asset for your organization, it's not a expense. The closing stock of the organization will be treated as an asset, so you will not take it into your expenses. You should remove it from your expenses, right? You only consider the cost of the goods that you sold. Now, the users of the financial statements require to know the value of the inventory that they had at the beginning of the financial period, the purchases that they made, and what is the closing inventory, and how much of goods were returned to suppliers, how much of goods were returned to us by our customers, okay, how much of sales returns were there. Now, in addition to the purchase value of the stock, there can be other costs that are directly incurred in acquiring the inventory. Like for an example, you have carriage inwards cost, which is the cost of sourcing the materials to the company, right? Like if you have to, let's say you are running a vegetable organization, right? You are selling fresh vegetables. So you will have to bring your vegetables from the farm. So that transfer cost, the transporting cost from your farmer to your organization, that is a carriage inwards cost, right? Then you have storage cost. You will have to store your assets. Then you will have freight insurance. If you are bringing it from another country, you will have to pay for insurance on it. Then if you are an organization who is manufacturing their own products, then there's going to be the manufacturing cost. Now to calculate the manufacturing cost, you will have a separate account which is called as the manufacturing account. Okay, so the video on the manufacturing account will also be available to you. So subscribe to my channel and press on the bell icon, so when it is available you'll get to know it. Then the simple accounting equation where we transfer the cost of the goods to the expenses is not going to be possible always when all these expenses come in and it becomes complicated. So accountants created their own method in which we calculate our cost of sales. Now the format of the cost of sales calculation is given to you here, right? Now the closing inventory of the previous year will be sold in the current year. Therefore, will be treated as an expense for the current financial period. And this is called the opening stock of the organization. So by the opening stock, the cost of the goods that you have will increase in the current period. Therefore, you need to add this in your cost of sales calculation. Then any directly attributable cost that was incurred on the cost of the goods sold should be added to the cost of sales, like the carriage inwards cost, the warehouse cost, the import duties cost, you need to add this into your cost of sales because the cost of the goods will increase by this. Then when you return goods, right, the purchase expense will decrease. So when the purchase expense decreases, the cost of the goods will decrease, right? Now let's say you had purchased 100,000 worth of goods. So this purchase of 100,000 will become a cost for you. Okay, it will become a cost of the goods. And then when you return 20,000 of it, the cost of the goods will come down to 80,000 because you are returning 20,000 worth of goods, right? So when there are purchase returns, the cost of the goods will reduce. Okay, so this will be shown as a deduction in your cost of sales calculation. And the closing stock will be treated as an asset. Therefore, this will be removed from your cost of sales calculation. So the asset closing stock is going to be removed, and this will be taken again to the next financial period because this is an expense in the next financial period. So you will show your closing stock as a deduction in your cost of sales calculation, right? So on screen you have a calculation that is given to you. So you can pause the video and start doing this calculation on your own based on the knowledge that you have acquired so far. Once you have completed doing this question, you can resume this video. Okay. So you are required to calculate the trading profit or the gross profit. For this, we'll be using the trading account. So you will have your sales. There are no sales returns here, so you need not record it. Then you have your cost of sales. From your sales, when you remove your cost of sales, you will arrive at the gross profit. Okay. Now you purchase 10,000 units at $5 each. So when you purchase goods, what happens is the cost of your goods will increase because you are getting more goods. So under cost of sales, you will add your purchases, right? So you purchase 10,000 units at $5 each. So the value of this is going to be $50,000. So your purchases will be 50,000. Then you sold 5,000 units at $9 each, which means you are selling this for 45,000. So under your sales, you will have 45,000. Now you are returning 1,000 units to the supplier. So when you return goods to the supplier, is he going to pay you $5 or $9? You paid $5, so the supplier will refund you only $5. So these 1,000 units will be valued at $5 each. So the value of the goods that you return will be 5,000, right? Okay. So now when you return goods, the cost of the goods is decreasing. So your cost of sales will decrease. So you show it as a minus or a subtraction on the cost of sales. So you reduce your purchase returns from your cost of sales, which is $5,000. Then you need to look at the closing stock. This closing stock is going to be considered as an asset. So you need to remove it from your cost of sales. So let's see what is the closing stock. The opening stock of this organization was 0. Then you have purchased 10,000 units, from which you sold 5,000 units. So after selling this inventory, you should be left with 5,000 units. But however, you returned 1,000 units, so you will be left with 4,000 units. So these 4,000 units will be valued at $5 each because that was the cost of a unit. So the value of your closing stock is going to be $20,000. So under cost of sales, you will remove this closing stock because it's an asset, should not consider it as an expense. So you remove it from your cost of sales. So you reduce your closing stock of 20,000. So guys, the cost of sales of your organization is going to be 25,000, 50,000 minus 25,000. So 45,000 minus 25,000, your gross profit is going to be 20,000. Okay, so you can cross check this. The profit per unit, your revenue was 9 per unit. The cost of a unit was 5. So the profit per unit was $4. You sold 5,000 units. So you should create a gross profit of 20,000. Right? So this is the answer for the second illustration. Okay guys, now that you have looked at that illustration, so there's another extra illustration that is given to you. Now in this illustration, there is opening stock involved. So try to calculate the gross profit on your own and then resume the video after you finish calculating the gross profit. Then check your answer with the answer that is given to you on screen. Okay.